to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three market catalysts we're watching this hour. First up, we dig into the latest economic data and what it means for the Federal Reserve. Plus, Tesla rallies on progress in its robo-taxi division. We'll dig into the outlook with Dan Ives of Wedbush. And we'll get a read on the state of consumer spending with the chief economist at the National Retail Federation. Let's get a check on the major averages here. We had, of course, the delayed jobs report today. And it was a mixed bag. We had downward revisions. We had a lot of job losses related to not the government shutdown, but Doge and the delayed effect of those cuts. But we had a more positive number for November than had been expected. So put all of that together, you get a mixed picture for stocks right now. The S&P 500 barely higher, the NASDAQ up about 0.25%, the Dow a little bit lower. We've been watching bond yields as well, of course, and we've been seeing some fluctuations and some volatility there as well. Well, as we mentioned, the November jobs report showing payrolls rising by 64,000, higher than the estimate of 50,000. Still, the unemployment rate ticking up for a fourth straight month to 4.6%. Joining me now, Mohamed El-Erian, Allianz Chief Economic Advisor. And Mohamed, listen, I'm having a little bit of trouble with this jobs report. I don't know about you, just in terms of getting that clear picture of what is really going on.
So we should really look through this report.
Okay.
There are so many distortions, and I think Chair Powell was absolutely right when he said we shouldn't take anything out of it. But if you put a gun to my head and say, ignore all the distortions, you have to come up with a conclusion, and I say, do I really have to? And you say, yes, I will tell you it just points to a weakening labor market.
And the weakening not just we talked to an economist earlier who said most of it has to do with the government stuff. If you take that out, it looks okay. Is that how valid do you think that assessment is?
So it is valid that a lot of it has to do with the governing government. We lost over 100,000 jobs there. However, if you look at the private sector, you see it's all about health and education. The other sectors are struggling. And if you extrapolate what's happening to the unemployment rate, you would worry. But I want to stress again, these data could be really distorted, and we have to be careful how we interpret them.
Okay, so let's leave the jobs report aside for a moment then. We get other jobs data to some extent, right? We get, various private surveys, we get the weekly jobless claims. So if we pretend this didn't happen this morning, and I said to you, what's the character of the job market right now, what would you say?
I would say weak, and most importantly, Julie, decoupling from GDP growth. So we are likely to see continued solid GDP growth and a weakening labor market. That is a relatively new phenomenon, and it's one that puts the Fed in a difficult position, especially given that the inflation rate is stuck around 3%. So we will look good in terms of GDP growth. We will look weaker in terms of the labor market, and we've got to keep an eye on whether inflation expectations remain anchored, which I think they will, but that is key.
Why is that happening? The weakening labor market paired with expanding GDP?
Part of it has to do with the role of AI. AI-related spending has become a major driver. It doesn't have the same multiplier effect through the economy as other spending does. Part of it has to do with the lower end of the household sector. The low-income consumers are having more difficulty. And I think looking forward, people are worried that as AI goes from being a demand issue to a supply issue, that decoupling may increase. It doesn't need to. I want to stress, it doesn't need to. If you talk to companies like Accenture, if you talk to a company like Walmart, they emphasize the labor enhancement side of AI. However, the tendency for a lot of companies will be the labor displacement side of AI.
Well, and how many companies, whenever you see these kinds of technological advancements, you also see them being used as an excuse or reason to slim down, even if it's not actually being replaced by that technology. How much of that is already happening, and how much of that do you think we will see? And how do you tell the difference, I guess?
It hasn't yet happened, and it's a risk. We've been in what people have called a low hire, low fire environment. If you're in a low hire, low fire environment, you think twice about getting rid of your labor force. If we suddenly see a spike in private layoffs, then other companies will use that as air cover. We haven't seen it yet. I want to stress, we haven't seen it yet, but that is a risk.
Going into next year, I've heard some optimism around the sort of tax stimulus that's going to be coming into the economy, both for consumers and for companies. How much do you think that will be a tailwind for 2026?
It certainly will be. I mean, we will have loose fiscal and monetary policy. We will have continued AI spending. We will have, as a result, solid growth above 2%, which compared to Europe will look incredible. But that central scenario, as compelling as it is, I don't think commands more than a 50% probability. You have two tails that are equally fat. One is a boom, literally a non-inflationary boom, as AI impacts the supply side and productivity goes up. And the other one is a stagflation if the bond market decides to refuse to fund as easily as it's funded so far all the demands from both the public and the private sector, and if there's a policy mistake. So it's going to be an interesting year because while there is a central scenario, it doesn't command an overwhelming probability.
Okay, I want to take each of those things and dig into them a little bit. Okay, so let's take the AI-fueled productivity first. It doesn't feel like we're there yet. And so I wonder, do you think that does start to really take hold in 2026? Is it the later part of 2026? And sort of what does that look like? How do we see that unfolding?
I do see it taking hold. So right now we're obsessed with those working on AI. Gemini 3, how wonderful it is. Oh no, wait, OpenAI is going to come up with something.
Yeah.
It's all about those working on AI. We haven't focused enough on those working with AI, the adoption issue. We don't have an adoption policy. It's not hard actually to put in place an adoption policy. If you freeze those working on AI where they are and you simply implement throughout the economy what they have achieved, you have a major productivity growth. That is only in AI. What about robotics? That is coming down the pike in an important way. So I certainly think that we will see it play out over a number of years. There is a possibility, not a probability, a possibility that it could be accelerated, but that requires corporate America to really increase the adoption rate.
Are you using it? And which model are you using? Do you have a favorite one?
So I use it all the time.
Okay.
I use Gemini. I think it's incredible what it does.
Like, what do you use it for? I'm just curious. I mean, I use it when I'm doing research for interviews, for example. I've been using Gemini also. So how do you use it?
So I use it for that.
Yeah.
I use it for checking what I write. I use it for looking at slides I use when I teach and ask a simple question, how do I make this more engaging? I use it for a whole range of things, and it has really increased my productivity. It also increases the time I spend on it because I get very intrigued by certain things, but it's incredibly powerful. I generate images, and you'll see, if you look at my weekly, you'll see the image generated. Underneath I put generated by AI. Right. And I simply say, when I read a long report, just to make sure I don't miss anything, I say, summarize the main points. So I use it all the time, and I find Gemini 3.0 incredibly powerful. Yeah,
like I say, I've been using that one too. So that's the one side of it. Let's talk a little bit more about Treasury supply, the bond market, because we've already seen little glimmers of that, right? At a time when the Fed is cutting, very unusually, 10-year and 30-year yields are going up. So is that a sign of things to come next year, that we could see more of that phenomenon in the bond market, especially with more Treasury supply coming to market? So
there's tremendous supply from the public sector and from the private sector. Data centers now alone are going at a rate of 150 to 175 billion a year in terms of debt issuance. That is big. Then you have a 6% of GDP deficit. That's big for this part of the cycle. What I worry about is at some stage the bond market is going to say, you know what, we're not pricing in risk the way we should be pricing in risk. That is part of the downside scenario we talked about, is that the bond market's appetite, which has been incredibly strong, somehow becomes less so.
And where do you put that probability?
So I have, and that's not going to satisfy you, I have a 50% probability for the central scenario and about 25% for each side. Okay. And the big message of this, whether you're a policymaker, whether you are a market participant, whether you are a CEO, don't fall in love with your central scenario. Just recognize that it's a multimodal distribution, and you've got to pay attention to the tails. And you've got to ask yourself, which tail can I navigate better?
Yeah, I mean, that's a good lesson over of the past few years. Don't get too wedded to that central scenario. Speaking of central scenarios and how things shift over time, we've got new betting odds on who's going to be the next Fed chair, right? That Kevin Warsh has really gained in the odds-making market here. You and I have talked before about who the next leader could be. Kevin Warsh, a good choice, better than Kevin Hassett? What do you think?
So Kevin has gone from below 10%. Today I looked on Polymarket just before I came in, he was at 47.
Warsh, that is.
Sorry,
yes.
Warsh.
Yes.
And Kevin Hassett is down to 41. So that's a complete transformation.
Yeah.
Now there's some circularity in this because it moved on President Trump's statements, and of course it then attracted people to bet. Look, I have a better view of what Kevin Warsh would do as Fed chair than I do of Kevin Hassett. Why? Because Kevin Warsh has gone beyond the interest rate issue. He has written about balance sheets. He has written about reforms to the Fed. He understands that a Fed that has got its analysis wrong, its predictions wrong, a Fed that has governance issue needs reform. So I'm comfortable with what he favors in terms of Fed reforms. And we know much more actually about what he would look like as a chair than we know what Kevin Hassett is going to look like as a chair.
As an aside, how nuts is it that we're talking about the betting markets and who they think the next Fed chair is going to be? Do you think that whole phenomenon, is that useful for markets? Is it useful for society?
It's not useful for this. I mean, it's totally nuts for this.
It's fun. It's fun to talk about.
Because it's the decision of a single person. It's very different from when you're trying to predict millions of people voting. That's very, very different. But having said that, it's the delta that's interesting because the delta has moved on comments from President Trump.
Yeah, the one person who's making that decision.
Correct.
Mohamed, thanks so much for coming in. It's good to see you.
Thanks for having me.
Appreciate it. Coming up, we'll speak to tech analyst Dan Ives, who's got some big expectations, surprise, surprise, for Tesla next year, what he sees ahead for that company and the rest of the sector. Tesla shares are near a record as the company confirming robo-taxi tests without a driver are underway in Austin. Tech analyst Dan Ives saying Tesla's ambitions in the autonomous business could drive it to a $3 trillion valuation by the end of 2026. When we talked to Garrett Nelson, CFRA research analyst, he's not quite as confident.
Looking at consensus numbers for 26 and 27, we think they're too high still, and we haven't seen the worst of the drop-off in their EV sales. In a couple weeks, when they report fourth quarter sales, we will see that fourth quarter being the first full quarter in which the U.S. market was not subsidized in terms of any sort of EV tax credit.
Dan Ives, Wedbush Managing Director of Global Head of Technology Research, is joining me now in the studio. Dan, I know what you're going to say. He's too focused on the spreadsheets. He's too focused on the car business. I know what you're going to say by now. But this is how the company makes most of its money right now. Mm-hmm. So, yes, I understand the AI future, but what about the car present for Tesla?
I mean, look, if you're owning it for numbers and for the car business, I mean, I think that's the wrong reason. I mean, in my
but it has to fund the other stuff, right? Mm-hmm. And it's funding it in part through selling cars. Mm-hmm. So it has to sell enough cars in order to not just make a profit, but also to fund some of these ambitions, right?
I look at it almost like a bracket. Like, in other words, like a worst case, base case, best case. As long as it's sort of above a worst case, and I think now it is in terms of deliveries, then the business model continues to play out, and that ultimately does fund what I really view as the key piece, right, which is autonomous and robotics future. Look, in terms of, if you started this year, and I told you where numbers was going to be at the end of the year, you're like, where's the stock going to be based on those numbers? You'd be like, it's $200, $250.
Right.
But it speaks to my view. I mean, you've talked about it a lot, is that when you look at physical AI plays, there's NVIDIA and Tesla, I think the two best out there. And now it's about proving it out. But that, as an investor right now, if you're bullish on Tesla, you're not focused on consensus 26.
Of course.
But to your point, I do think deliveries has stabilized. I think China's actually shown growth. And you look at the last few quarters, like it's actually better than expected.
I'm curious, because you said you have worst case, base case, best case. What's your worst case scenario for Tesla?
Well, I think worst case, if you go back like 6 months ago, I mean, we were
That felt like worst case, yeah.
It felt like worst case because also given deliveries, given a lot of the brand issues, given what you saw in Europe, and obviously, tax credits coming off in terms of the U.S., so we were trending toward a worst case. And look, it spoke to my view where Musk needed to be a wartime CEO focused on this core Tesla chapter, which I view as probably the most important chapter ever for Tesla and for Musk. So I think you now are seeing a different Elon. You're seeing a different company. And look, Julie, I think we sit here a year from now, the stock's at 650, 700, or it's lower than here. In other words, like this is a very...
Like a make or break year.
I'd call it a make or break year, and I think it's going to be make relative to autonomous 30 cities, showing the volume production, not just delaying it. And I think that's why it's such an important year.
Okay, so you mentioned a couple of the goals there. Like, give me the top 3 things that it needs to do this year to push it higher rather than going
Well,
lower.
one, I mean, you need to be in 30 cities. I mean, when you look at Austin and now what we're seeing in California and some other cities, you need to be in 30 cities by summer.
With the robo-taxis.
With robo-taxi. So that's one. 2, no safety driver. Now you're starting to see that now in Austin. We saw it firsthand. You need to see the geofence area expand to a point where I believe it gets significantly more than where Waymo is, right? Relative to even having a huge head start. And I think the third, it's volume production. In other words, like you actually need to show volume production of cyber cabs coming out of Gigafactory in Austin. Look, I think those are the 3 that are extremely important to show. Okay, is the whole story going to take hold this year? No. But it shows that like those are huge building blocks to what I view as kind of the future of Tesla.
And it's interesting that you say that because like Musk has always been good at vision and big pronouncements, but what you're talking about is execution. And there his record has been less even or at least less consistent on time, right? He's had a lot of delays in the past. So you're confident, though, that you think he can hit those goals?
Look, it's just like SpaceX. I mean, you're trying to solve the most complex AI, I'd say like some of the biggest problems out there. And when you do get to full autonomous, you're dealing with lives, you can't just be 99%. I mean, so you're talking about the margin of error you almost can't even, look at in a spreadsheet. So this is something where it's so important that they do this from a safety perspective and continue to stretch it out step by step. But look, I mean, I think autonomous alone is worth $1 trillion. And I think when you look at robotic, you look at Optimus, you look at this all playing out, that's how I get to, in a bull case, a $3 trillion valuation, at the end of 26.
Okay, I'm curious about something. I know that they've put Grok in some of the Teslas, right, which is the XAI LLM. Have you been in one of them that has Grok? Like, how do you even, do you talk to it while you're driving? What do you do with it?
Yeah, it's interacting with it, and I think that's something.
You just like need somebody to chat with? You chat with your Grok in the car? What do you do with it?
But to some extent, it speaks to like that's going to expand because the whole view is that this is all part of the Musk ecosystem. I mean, Tesla is going to own, I think, a decent sized piece of XAI. You'll get SpaceX that's going to go public next year, and I think it's possible Tesla will also have ownership, or at least a piece of SpaceX. And then you look at Grok and you look at everything that's happened here. I mean, I think eventually what this is all going to, there's going to be some holding structure that you're probably as a public entity in terms of Tesla, XAI, whatever they own of SpaceX and some other things. But look, I think this is sort of the vision for Elon. He recognizes in this arms race with Altman, with Jensen, with Nadella, with what we see Carp Palantir and everything else, this is the time. This is not a time to watch from the sideline.
Yeah. Okay. I was just talking to Mohamed about how he uses. Thank you. How he uses these large language models. Which ones I'm curious. Are you a ChatGPT guy? Are you a Grok guy? And how are you using it?
ChatGPT, also Gemini. Use a little Grok and Perplexity. So I use it for different things. I think each has its strength. Now, look, I use it every day in terms of like organization, content. It's one where like solving different problems, like my travel. I mean, so depending on different ways, like I use them, but it's something where this is just the beginning because you think about like autonomous, like most consumers, the models are just the beginning. it's going to be like robotics. It's going to be, when you look at autonomous, it's going to be what ultimately will be like Apple having a true AI store in terms of apps. And I think that's where everything's heading. This is just a year 3 of an 8 to 10 year build out.
I know that Brian Sozzi, I don't know if you know, OpenAI is Yahoo Finance Company of the Year. And he was zeroing in on the idea that OpenAI might come out with a phone at some point. Do you think that's a competitor for the iPhone, or do you think no?
I wouldn't say necessarily competitive to the iPhone, just like when we've seen other companies try to, go after that. But it does speak to what Sal was talking about as OpenAI, like they're planting flags everywhere. Because what they're essentially doing is like, look, they're building the stack. I mean, you could say it's a combo Amazon, Apple, Google all combined in terms of what they're doing. Look, some have criticized in terms of that, and I think you've seen names like Oracle, obviously, that's been overhang on it. But I just continue to view like you're building out a new economy. Like you're talking about trillions being spent. For the first time in 30 years, the US is ahead of China when it comes to tech. And that's very important relative to where OpenAI stands and relative to, I think, the US ecosystem in terms of big tech.
There's another stock I want to ask you about, and that is CoreWeave, which, as you know, has sold off pretty sharply. Maybe the company didn't sort of message very well about some delays at one of its data centers in terms of construction, or one of the data centers it's leasing, not that it owns. Are you worried about that name, in terms of execution risk, in terms of debt, in terms of the business model?
Yeah, I'm not. I mean, because I look at CoreWeave, Nebius is another one in terms of some of the neo clouds. Look, my view is like you're going to see things quarter to quarter move out. You're going to see some blemishes in this really fourth industrial revolution. But I don't view it as sort of these panic moments, everyone heads for the elevator, yelling fire in a crowded theater. I mean, I do think this is one where it's going to be hyper-focused, but the onus is on them to execute, communicate it. Because right now, like, look, investors are so sensitive naturally, right, in terms of, like, is this a bubble? Again, like I've told you, I think it's 10:30 p.m. in that AI part that goes to 4 a.m. But the responsibilities on the companies to communicate.
Okay, so let me ask you this then. Like, I understand the thesis on the whole AI space, but if there are ones that are maybe a little bit higher risk in terms of messaging and execution, why not avoid that one? Why just not buy the other ones that don't necessarily have that risk?
No, and like in our ETF, like we have the 30 AI win. I mean, CoreWeave's one of them, but the point is like you can just like bet on one company. I think you do have to, like, whether it's Godfather of AI, Jensen, NVIDIA, whether it's AMD, whether it's Micron, on the software on the hyperscaler side, bet on your Palantirs, the MongoDBs, the energy companies, the GE Vernovas and others. So I do think, like, to that point,
you disperse it.
Because you have to think about like a barbell approach. If you just bet on one, there's risk, right? In terms of like what could happen with that company. I mean, Oracle being a perfect example. I think when it comes to the best way to play AI revolution, you have to own some chip names, software.
But I guess I'm asking, why not avoid, say, a CoreWeave and an Oracle? Why not just leave them out?
Yeah, look, but to that point is investors be like, oh, you don't touch them, they're toxic. But then let's say 6-9 months from now, you're like, okay, how come I didn't buy Oracle 180 when now it's 240? So my view is like, if there was structural issues, if I didn't believe in the thesis, if there was something that felt like it was a business model change, then you avoid them. But I don't believe that is, but it speaks to like, look, you need like, strong hands and sort of, a strong stomach to battle through some of these sort of like waves that we're going to see, the DeepSeek moments, Liberation Day. I mean, we'll have more in 26, right? But it speaks to my view, like you'll be wearing a S&P 7,000 hat, an 8,000 hat in New York Stock. Like that's my view where we're 2 more years left in the tech bull market. And again, the bears in hibernation mode, they can't see in their spreadsheets. They've missed every transformational tech stock the last 20 years, focus on what could happen.
We'll talk again, Dan. Thank you so much for coming in. Appreciate it. Coming up, we're taking a look at some of today's trending tickers. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Bertie Palmer, live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. Today we're watching shares of Roku, Estee Lauder, and Okta. First up, Roku. That stock moving higher today after it got a double upgrade from Morgan Stanley. The firm upgraded shares from underweight to overweight, and the analyst said the company's revenue growth accelerated in the second half of 2025, which means it ramped up its user base, plus it was able to deepen its streaming partnerships. And that positions the company as a continued beneficiary of an industry tailwinds. There are now 27 buy ratings, 8 holds, and 1 sell rating on the street. Next up, Estee Lauder, because Bank of America has set a new street high price target on the stock of $130 and reiterated its buy rating. The analyst called it a top pick in beauty for 2026, saying that she's encouraged by its Beauty Reimagined plan, which is focused on rebuilding revenues through innovation, higher exposure to fast-growing distribution channels, and increased spend on consumer focus. It also expects an overall improving beauty market next year in the U.S. and China. But keep in mind, the average 12-month price target on the street is $104. Last up, we're watching shares of Okta because those shares are moving higher today after Jefferies upgraded the stock to buy from hold. The firm also raised its price target to $125, up from $90. It believes improving go-to-market execution, stabilization in the customer identity business, and growing demand tied to agentic AI could drive revenue growth above current consensus expectations. There are now 30 buy ratings, 13 holds, and 2 sell ratings on the street. Keep right here on Yahoo Finance. We'll be tracking all the market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching B. Riley, Booz Allen, and Fannie and Freddie. First up, B. Riley. The financial services firm filed an overdue report with the SEC in an attempt to remain listed on the NASDAQ. That 10Q report showed that B. Riley swung to a profit during the quarter from a loss a year earlier. The company struggled to file timely reports comes amid a turbulent time for the firm. It's grappling with soured investments, flaws in financial reporting, and an ongoing civil investigation into its dealings with a former business partner. The reporting delays left investors uncertain about where the firm's finances stood and spurred NASDAQ to repeatedly threaten B. Riley with delisting. This seems to have calmed some of those concerns. Next up, Booz Allen. The consulting firm has announced a change within its C-suite. Current CFO Matthew Calderone is resigning from the company. The announcement appears to be weighing heavily on those shares. Booz Allen has appointed an interim CFO. It's initiating a search for Calderone's replacement. The share is down 7%. And Fannie and Freddie, Treasury Secretary Scott Bessent says the mortgage companies will be going public in 2026. Bessent told Fox Business the Trump administration is working deliberately on the public offerings it's targeting next year. Notable investor Bill Ackman recently bet big on the companies and laid out a plan to the White House to bring them out of government control. That plan calls for relisting Fannie and Freddie on the New York Stock Exchange, writing down the Treasury's senior preferred stake, and exercising the government's option to acquire nearly 80% of the common stock. Fannie shares have soared around 650% since the start of November last year, but they're down today. Coming up, home builders continuing to deal with rising construction costs and economic uncertainty, what that means for buyers heading into 2026. Stay tuned. You're watching Market Catalysts. Homebuilder confidence ending the year in negative territory despite inching higher in December. Rising construction costs, economic uncertainty, and affordability concerns continue to weigh on the housing market. Yahoo Finance's Josh Lipton spoke to Jim Tobin, CEO of the National Association of Home Builders.
So let's get right into this, Jim. Builder sentiment, we are still stuck here in the 30s, Jim. Not great. What explains that, and what do you see ahead?
Well, Josh, good to see you and your viewers. We're still stuck in the uncertain times. This year we have been for now 12 months in a row stuck below 50%, which is our break even point. Actually stuck in the 30s all year. Just a year ago we were in the 40s. So we've seen a decline and then a stabilization over these last couple of months. It's uncertainty. It's mortgage rates stuck stubbornly above 6%. And it's also the pace of construction. We've seen a lot of people trying to eat through the inventory that are already in the ground. So it's a combination of things that are really keeping the market constricted at this point and unable to kind of break out and into that positive territory.
How much relief, Jim, is your industry expecting from the Fed, which just did deliver another cut? What are you seeing and hearing?
Well, certainly the latest rate cut is good news for on the construction side. Construction lending loans are pretty much directly pegged to the overnight rate. So that is good news for those who are getting ready to start some projects or starting to pencil some out for next year. Mortgage rates, we expect them to follow a little bit. Obviously, we'll see what the bond market does as they continue to read on the overall economy and debt and deficit. But we don't expect the Fed to cut again in January. I think they're going to take a wait and see. Your last report there talked about more data having to come in about whether inflation is tamed. I agree with the Fed governor who talked about shelter inflation starting to come down. That is the last most stubborn piece of the inflation puzzle as rents continue to fall. I do believe that's going to help that overall inflation number get closer to that benchmark rate of 2%.
Just to put a number on it, Jim, so the 30-year fix here is at 6.29. That's according to Mortgage News Daily. You have smart economists on staff. What do they see, Jim, over the next 12 months there?
I think we're going to be hovering right around the same level for most of, if not all of 2026. We don't expect our mortgage rates to get, consistently below 6% and into those mid to high fives until early 2027. Now, that said, if we do see the pace of production pick up, we do see some relief from tariffs, or at least a lessening of the potential impact on tariffs. I do think that we could see some rates go down in the end of 2026, but we think we're going to be bumping along here at 6% or even a little bit higher for the better part of a year.
Jim, let's talk about tariffs because you call that out. You say tariffs are having serious repercussions. Walk us through that, Jim. How so?
I think it's more from the macro effects of the tariffs. It's just the uncertainty of what tariffs are going to be. For months we have predicted that the tariffs are going to add, $10,000 or $11,000 to the cost of a house. As I travel all over the country, I have heard, from our members that impact is much lower, maybe $2,000 to $3,000. So there is an impact, but it's not as high as I think that a lot of people have foretold. Yet, it seems like everybody keeps talking about, but tariffs are yet to take effect. Yeah, tariffs really haven't bitten yet. We're going to see that in the next quarter. So I think that we're still waiting to see if tariffs are really kind of where they're going to be, or are we going to see them bite a little further? I'm hoping for the former, that we've seen the worst of the tariff impacts and we can absorb those into the economy. I think Governor Myron said that already, but we'll see. But until we get that answer, I think that's where we're going to see this real uncertainty continue into early 2026.
This was another interesting stat, Jim, stood out to me. 40% of builders cut prices in December. Is that just seasonal, Jim, or no? Does that suggest something more long-lasting here? What do you see for home prices ahead?
It suggests to me that there is inventory that is sitting idle, that mortgage rates have continued to keep people on the sidelines. Of course, we've heard that the job report, while we haven't seen government data for a little bit now, we expect that the job market is very soft. So it's hard for people to make that move either for a new job because there aren't any, or because they're not confident in keeping their own job. So the job market itself, I think, is keeping people on the sidelines. Therefore, we're seeing those deep discounts offered by a large percentage of builders to get that inventory off the marketplace so they can go ahead and start planning and building for 2026.
A bigger picture question for you, Jim. You know this. Affordability is a key issue right now for a lot of Americans. Housing is front and center there. And the question is, to address that, how do we unlock more supply in this country? And I'm just curious, Jim, when you think about that question, what are the big bottlenecks to that, Jim? Is it zoning? Is it labor? Walk us through it.
Yeah, first and foremost, it's land use policies at the local level of government in this country. We have got to get local policymakers and decision makers to open more land and be open to more home building, because we know that if we build more housing, we can lower costs and we can make housing more affordable. So we've got to get that local government to open up that land, which means that they have to say yes to more housing, and they have to say no to the NIMBYs out there, the not in my backyarders, who refuse to let people have the same opportunities that they had when they were new to those communities, and let people build and have a piece of the American dream. Next, of course, labor. Labor is one of the largest impacts. We've got to train more skilled laborers in this country to build housing more affordably. And we have to have a reliable and affordable building material supply, and that goes to speaking to tariffs. It goes and trade, but also our domestic supply and doing what President Trump wants to do, which is increasing our economic output of building materials here. And then finally, it's making sure that we have a good lending rates. We talked about the Fed actions dealing with construction loans. Mortgage rates need to come down next, kind of the financing piece, the lending piece of the equation. If all four of those can get moving in the right direction, that's what's going to unlock the housing market, and that's going to unlock home construction in the country.
Finally, Jim, you mentioned President Trump there. I'm just curious to always get your check on this. His immigration policies, Jim, what kind of impact is that having on your industry, and how are they navigating it?
Well, very carefully is the answer. There have been more increased raids over the last couple of months. Hearing from many members from across the country that are found their job sites severely constrained by either the potential of job site raids or raids themselves. So that's why it's really important for us to get to comprehensive immigration reform, get Congress to work together to actually come up with a solution. There's legislation right now in Congress that would do that, that would find a pathway forward for those that are here in the country, also allowing people to come in here and work in the industry legally. Critically important that we do that, but we also have to train those that are here, those who want to work in this industry, rededicate ourselves to making the trades great again and putting the resources and the energy behind creating opportunities to train more people in the skilled trades. It's a whole of government approach when it comes to the labor equation.
Jim, always great to see you. Thank you, sir.
Thanks, Josh.
Coming up, we got October retail sales numbers this morning, but stay with us. We'll get a peek at November's numbers based on consumer debit and credit card data. You're watching Market Catalysts. Retail sales were flat in October. Those numbers released by the government are based on surveys. The National Retail Federation is out with its November sales data. That's based on credit and debit card purchases. And it shows that while sales for the first half of the holiday season were flat compared to October, they did show gains compared to a year ago. Let's bring in Mark Matthews, National Retail Federation Chief Economist and Executive Director of Research. Thanks so much for being here. So if you're looking at these spending trends through that lens of credit and debit card data, what is it telling you about, the sort of narrative that's out there about consumer spending versus the reality of consumer spending?
Yeah, thanks so much for having me, Julie. It's interesting because it's important to recognize that we have some seasonal factors to take into consideration. So this year we had a relatively late Thanksgiving, which meant that Cyber Monday actually snuck into December. So when we compare month over month, as you said, we had a flat number. But for us, the more important thing is the year over year, and almost 4.7% growth year over year. That's really positive. We feel like, as we did last year when we had a relatively soft November, because again, we had a late Thanksgiving, we're going to have a strong December. Because Cyber Monday is part of December. And also, we released a survey recently that showed that consumers are telling us that about 160 million of them are going to show up on Super Saturday. That's the last Saturday before Christmas. So we expect to have a relatively strong December. We still have consumers telling us that they have about half of their shopping left to do. A lot of procrastinators out there. So we're pretty bullish heading into December.
Mark, how much of the increase in spending is inflation versus people spending more or buying more stuff?
Yeah, it's a great question. There is some inflation, but not as much as you might expect, right? So up until the last few months, goods inflation has been negative. There's actually been deflation in goods. In the last few months, we've started to see that pick up. But we're probably talking about something in the range of about 1% on goods. So when we're talking about 4 to 5% growth, most of that is actual real growth in spend.
And Mark, is there a way of knowing how much of this spending is accounted for by the top third or decile even of Americans by income?
Yeah, we've actually been working with our partners, Affinity and Pixis, who help us analyze this credit and debit card data. And we've actually been doing some analysis that we're going to release in a little bit of time that shows spending by decile. And you absolutely do see higher income households driving spending particularly on a year-over-year basis. So that all that talk about the K-shaped economy, we absolutely see that in some of the spending data. There's almost a straight line when you look at on the left-hand side, lower income households, and on the right-hand side, higher income households, in terms of their growth and spend over, across all sectors on a year-to-year basis.
And it's interesting. We're showing some of the spending by sector, although probably year over year is more interesting than the month over month. But like digital products up almost 15% year over year, unadjusted, or I guess unseasonally adjusted. So what is this telling you about what people are spending on, what kinds of gifts they're buying?
Yeah, definitely worth understanding that the digital products is a relatively small category.
Got it.
And it's things like, buying video games online or ebooks or anything that isn't physical. But when we talk to consumers and we ask them what they're buying for the holiday season, the number one answer we're getting is apparel. That's top of the list. And then obviously gift cards and toys. When we talk to consumers about what they want to receive, the number one thing is a gift card. So we expect to see actually significant spending after Christmas when people get those gift cards and they go out shopping for the after Christmas sales. Right.
I mean, that revenue, though, is recognized when the gift card is purchased, right? Not when it's spent, if I remember correctly.
Yes.
Right.
Yes.
So overall, when we're looking at these numbers, and as somebody who's been tracking retail spending for a while, how does this compare? Where are we sort of in the spectrum of what spending typically looks like?
So if we look back, remember that pre-pandemic, during the pandemic, we had some pretty strong years. So if we throw those out and we look at the 10 years pre-pandemic, the average growth for the holiday period was about 3.6%. We are trending towards something along the lines of 4%. We forecast sales growth between 3.7 and 4.2% for the holiday season. We expect to probably hit those numbers. That is obviously above trend growth. So again, I think the consumer right now is the bright spot in this economy, right? They're going out there, they're spending, and even if wages aren't increasing as fast as you'd hope they would, consumers are actually spending more and saving less to ensure that they can spend on family and loved ones. The one trend that we've seen over the course of the year is that for every single event where consumers were spending on family and loved ones, if you think of Mother's Day, Father's Day, Valentine's Day, back to school, we have seen record or near record spending. So there is almost consumers are protecting spend on family and loved ones during these events.
That's really interesting, Mark, and maybe that helps answer my next question, which is why, I know it's not unusual for sentiment surveys to be very divergent from what people actually do, but it still feels odd to have sentiment surveys as sort of lousy as they are on balance and then see these kinds of spending numbers. So in your experience, how unusual is it really, and what do you think accounts for that?
Yeah, really, really interesting question. And what we have seen since the pandemic is a tremendous dislocation between sentiment and spend. Post-pandemic, 2022, 23, when inflation was really, really high, we had record low sentiment and yet record high spending in the retail sector. And that is continued. So we continue to see relative weakness in the consumer sentiment, but very strong spending. And the way I like to think of the consumer is that they're sentimentally weak, but fundamentally sound. And what I mean by fundamentally sound is that we continue to see wages grow above inflation. For the last 30 months, we've seen real wage growth. Unemployment remains in, relatively low territory. So we have a consumer that has the ability to spend and also the desire to spend. So despite that weak sentiment, we see them out there shopping.
All right, we'll see how it all shakes out when all's said and done. We'll check back with you in January, Mark. Thank you.
Sounds good. Thank you.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Minutes into the start of U.S. trading. I'm Julie Hyman. Let's get a check of the markets here. As we take a look at the major averages, we still see kind of indecision here today in the wake of the jobs report that did show sort of a mixed and murky picture for what the characteristics of employment in the U.S. are actually like. So right now, the Nasdaq, little change to the upside. The S&P 500 and the Dow are each falling by about 0.25%. Procter Gamble is one of the worst performing stocks in the Dow Jones Industrial Average this year, despite the index being up more than 13% overall in 2025. So we're taking a closer look at the company as part of our series Down Bad. Joining me now, Filippo Falorni, Citi Vice President of U.S. Beverages and HPC Lead Analyst. Good to see you, Filippo. So I guess let's first of all talk about what happened to P&G this year. And maybe, it's sort of capped off by the CFO talking about, personal product category sales being down. But what do you think sort of went wrong for the stock this year?
Yes, absolutely. Hi, Julie. Thanks for having me on. Look, I think what happened this year is that there's been an organic sales deceleration for Procter & Gamble. Just a couple of years ago, the company was growing 4 or 5% organic sales, which is a measure of volume and price mix. And then more recently, they've delivered more somewhere in the 1 to 2% range over the last couple of quarters. I think, look, there's a couple of components. I think the big one that drove the deceleration is pricing. If you remember from 2021 to 2024, CPI was running very hot, and most of these companies were taking like mid-single digit pricing, high single digit pricing in certain categories. And that has slowed significantly to the point that now pricing is flat year over year, and in certain categories even down because companies are having to promote to stimulate demand. And then the second point, which you mentioned, this Procter & Gamble CFO called out at a recent conference, is that the consumers are cautious in their purchasing behaviors. And remember, P&G plays a little bit at a premium point in most of their categories. They are the more premium offering. And so they are seeing consumers being a little bit more cautious with their spending, a little bit of trade down, although not super material. And so all these things result in volumes being slightly negative, with pricing now also not growing much, and that results in flattish to slightly up sales growth.
Yeah, the company definitely doesn't want to see both pricing and volume not working for them. Okay, so what happens then for this company and the stock in 2026? Do you see any kind of inflection here for it?
I could see some improvement in 2026. I'm actually more optimistic on the space for a couple of reasons. I think what you've had this year is that you have really a normalization in sales growth trends. If you take a look versus the pre-COVID trends, most of the household product companies were growing sales, again, in this very low end of low single digits. I do think investors got used to like more mid-single digit growth on top line. But again, that was it was driven by very significant pricing that is not sustainable in this industry. So we kind of got the negative stock impact from the normalization of top line. And then as I look ahead of 2026, there were some discrete impacts that negatively impacted 2025 sales. The first one was the inventory destocking at retail. So at the beginning of the tariff this conversation, and when the first round of tariff were introduced in March and April, a lot of retailers focus on categories that were more impacted by tariffs. Right? Think about electronics, apparel. And so some of the more traditional household product categories were put on a second kind of priority list. So definitely the manufacturers sold less into retailers. You're going to cycle a lot of those impacts in early 2026. And then the other thing to me is like household product categories, those are daily use categories, right? Like we're talking about household cleaners, paper products, toothpaste. Those are categories that are very, very stable in terms of consumption levels. And so is you get to normalize this more cautious consumer environment. That's not going to be a year-over-year headwind for these companies. And so I actually do think there's going to be potential improvement in the top line trajectory. And the other thing is, look, in the consumer staple space, another big debate is the impact of GLP-1 drugs on food and beverage. And obviously, the household product companies don't have any risk more structural in terms of demand. And so they could be also, from an investor standpoint, a return to these companies that are more stable within consumer staples.
Interesting. And you mentioned the effect of tariffs on ordering for P&G products. What about on its margins themselves and on the whole, pricing decision process?
Yeah, no, that's a good question. I mean, throughout the year, there's been a constant update from the company on their tariff impact on margins. We went from the initial guidance was 1.5 billion, 1 to 1.5 billion, and now we are about 700 million. So still very significant for the company in terms of increased cost. They did pass some surgical pricing, but as I mentioned before, pricing in aggregate has really decelerated because a lot of companies took a significant pricing from 2021 to 2024, and they realized that the consumer could not take another leg up in pricing without compromising significantly volume. So there hasn't been a significant price offset to the tariffs. So that when you think about 26, that's another thing that you're going to annualize in terms of the impact. And remember also the initial tariff rates on countries like China was higher than what it ultimately came down to with negotiations. So a lot of these companies on a year-over-year basis are going to have a more favorable margin outlook into 26.
I'm curious too, Filippo. P&G has sort of rolled up a lot of different brands. So do you think they're going to be adding to the portfolio at all in 2026?
Yeah, look, M&A has been clearly heating up in my space, in consumer products. We've seen some very large-scale deal like Kimberly-Clark acquiring Kenvue, Keurig Dr. Pepper acquiring JDE Peet's. So we've clearly seen an increase in M&A activity. From the P&G standpoint, they've been very disciplined and rational with their acquisition strategy. And so I'm expecting them, if they decide to go with the M&A route, they will probably look more medium-sized deal rather than large transformational deals. They've done a couple in the past in their history. The last big one was Gillette. But they've also learned a lot from those large-scale deals. And the message from the company has been much more looking at kind of white spaces and portfolio gaps, but again, more in the medium to smaller size.
Filippo, thanks so much. Appreciate it.
Thanks for having me.
Coming up, the top trending tickers of the year. Jared Blickery has a closer look next on Market Catalysts.
2025 has been a year of surprises. At the outset, many pros were doubting that year 3 of this bull market could match the outside gains of the prior 2. But the AI trade, it keeps driving attention and driving behavior. And on today's Stocks in Translation, we're not looking at the best performers of 2025. We are looking at the names that you, the viewers, checked in on the most on the Yahoo Finance platform. And we're breaking down our top 10 trending tickers of 2025. So let's take a look at the scores on the door. And here we got the top 10 tickers. The first thing you might notice is that this is an AI-dominated list with maybe Bitcoin in the middle as the exception. Then you're going to see the perennial favorites, that's NVIDIA and Tesla to the left there. They are in a different zip code. Our NVIDIA quote page has a cool 250 million page views this year, while Tesla clocks in at over 180 billion. And while Apple is usually top 3, it was edged out this year by Palantir with nearly 100 million views. And from there, things stabilize as AMD, Amazon, Bitcoin, Meta, Supermicro, and Intel, they all clocked 40 to 60 million viewers each. Now, let's take a look at this list from a different perspective. This is our Yahoo Finance heat map, and we're looking at the box size right here. So each box size corresponds to the market cap of the company, and all of these are large to mega caps, with 2 in the $4 trillion bucket. That would be NVIDIA and Apple, all the way down to Intel over here at 180 billion. And in the far lower right, you almost can't see it there, you can see Supermicro, which is just shy of $20 billion. But the other thing you might notice is that the only losing ticker this year is Bitcoin, although Amazon is pretty close to break even too. So each of these has a different story. Now let's dive into some of the charts that really tell this story. And this is going to be a year to date. So we'll start with NVIDIA here. This has arguably been the poster child for the entire AI trade. And you can see it got kind of sucked into the post-Liberation Day redness there, but it has bounced back strong. It really hasn't done much over the last few months, but with 30% gains in a year after almost being up, 1,000% over the last 3 years. There you go, 963%. I think investors are going to take that. Now Tesla. Tesla's really interesting because over the last year, and this is a 3-year chart too, it has traced out a cup and handle formation. If it can break above 480, it has the ability to really break out, and 2026 could be the year to do this. If it fails at this level, well, maybe it's got to consolidate a little bit longer. Now let's take a look at Palantir. This stock is up 2,500% over the last 3 years. Let's dial down to a year to date. And you can see, like NVIDIA, hasn't really done much over the last few months, but still sitting on 140% year to date gains. Now, Apple, year to date, this stock is only up 9%, but it has come back nicely after it just kind of stalled out after the Liberation Day melee, where a lot of stocks were taking off. It was going sideways, but it finally caught up over the last few months. And so Apple has been generating recent record highs, even as NVIDIA has been going sideways. Now here's AMD to round out the top 5, 71% year to date. This is a very volatile stock, but again, I think investors will happily hold on to gains like that for a stock like AMD. Now, Amazon, barely positive for the year. This is a stock you kind of got to look at over this entire 3-year bull market. Still up 150%, but this was a year of consolidation. We'll have to see if 2026 breaks to the upside or the downside. And you know what? Bitcoin is a very similar story, sitting on more gains over the last 3 years, but this has been a year of consolidation. It happens to be down about 10% right now, and 75,000 is the line in the sand that I am watching. I think that gets hit before it takes off again. Then Meta, this is another 3-year story. Hasn't done much this year, but we'll have to see if it can continue the trend. 445%, very strong over this bull market. Getting towards the end here, Supermicro is a very volatile stock, and while it's up this year a decent percentage, you can see it was up a lot more in early 2024. So this is one of those high beta plays you got to trade with caution, but guess what? The Yahoo Finance audience loves to day trade this stock. And finally, here's Intel. This is another kind of sine wave pattern here. Let me just dial this down to year to date so you can see it has really taken off over the last few months. It's become a volatile stock, but it was doing nothing for the first 6, 7, 8 months of the year. So I think investors at the end of the day, at the end of the year, are going to be pleased with this one. So let us dial it back down here. I got a few things that are going to tell us what to watch in 2026. So just think of these as the questions that move these tickers. First is the AI spend payback test. Investors are going to want to see the revenue and not just the profits of these companies, not just the spending. And then next up is margins versus mega cap spending. Can these giants keep growing without the profit engine getting dented? Third, keep an eye on the chip cycle inflection point. Does demand for semiconductors, does it broaden out, or does it just stay limited to AI? Fourth, watch those crypto regulation headlines. 2025 was arguably the best year ever for crypto regulation, and Bitcoin isn't even positive, so let's see if sentiment can shift. And finally, monitor those rate cuts versus a real economy. If we get more cuts, ask why. Is it a soft landing scenario, or are we sinking into recession? Bottom line, these were the tickers investors just could not stop watching in 2025. Next year, what matters is whether the stories hold up, and that's where the rubber meets the road. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts up next.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ. Let's get a quick check on the latest market action. We're about 2 hours into today's trading session, and we're seeing red across all 3 major indices, with the NASDAQ leading the downward momentum, or rather the S&P 500 leading the downward momentum, down about 0.4% as we make our way and investors assess that jobs report that we got, that delayed November jobs report that showed that we added about 64,000 jobs last month. That was more than anticipated, but we did hear that unemployment is now the highest highest it's been since 2021. It's now at 4.6%. And so as you can see here, the S&P 500 still seeing downward momentum. The NASDAQ, after seeing some upward momentum at the open, we are seeing it in the red, down once again about 0.2% in the Dow as well, also moving lower as we make our way into this trading week as well. I do want to take a look in particular at what exactly crude oil is doing right now, because we are seeing crude oil move lower, down about 2.6% in intraday trading. Now, if you take a look, this is actually where we've seen over the past 5 years. This now marks the lowest that it's been since the start of 2021. Once again, crude down 2.6% as we make our way into today. We also have Brent crude oil also moving lower, also down about 2.6% as well. And taking a look at what exactly is leading the downward momentum for the NASDAQ here, we are seeing Google, Apple, Nvidia, Microsoft, Broadcom, Qualcomm, all in the red today, but really a bit of a mixed picture, but mostly in the red as we make our way towards the middle of today's trading session. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves, though, throughout the session.
November's jobs report showed the nation's unemployment rate ticked up to 4.6%, while 64,000 jobs were added after government job losses hit the rolls the prior month. Let's take a look at the impact that AI is having or not on the job market, plus the sentiment among hiring managers about it. Joining me, Martha Gimbel, Budget Lab at Yale Executive Director and co-founder, and Corey Katenga, LinkedIn Head of Economics of the Americas. Martha, I want to start with you, and I said AI or not, because I know that you tweeted about this and you said, whatever happens, please don't say it's all about AI. Okay, so it's not all about AI, but how much of any of the dynamic of the job that we're seeing in the job market right now is about AI?
Very little. It's not to say that there's no person in the United States whose job has been affected by AI. That is obviously untrue. But, we at the Budget Lab have looked at this, and we really can't find any sort of macro effect of AI on the labor market. One of the things I like to say is, the Fed started its hiking cycle at about the same time that ChatGPT was released. And if you had, put me into a coma at that time and woken me up now and showed me what the labor market looked like, my immediate response wouldn't be, oh, massive technological disruption has happened. It would be, oh yeah, cool. We've gone through a Fed hiking cycle. That's what this looks like. And so I think we all just need to take a step back, take a deep breath, and remember that the macroeconomic cycle will dominate almost anything else.
Well, and Martha, what we tend to see also is that when you have these technological trends that maybe there's chatter around the effect of AI as a sort of thing to blame, right? When in fact, maybe it's things going on in the economic cycle. How much of that is happening yet?
Oh, I think it's very easy and tempting for people to say, oh, we're laying off people due to AI. If you look at the Challenger announcement data, so, looking at what CEOs say layoffs are about, they say that that AI is responsible for about 8 times as many layoffs since April as tariffs. That just seems highly implausible. But you can understand why, if you're a CEO, you want to, cast a positive story about productivity enhancing investments, as opposed to, the macroeconomic situation is really hard and we have to figure out how to handle it.
Corey, I'm curious what you think of this situation through the prism of LinkedIn, where you guys see a lot of hiring managers active, where you see a lot of people, posting about what's going on with jobs. How do you think AI is affecting the dynamic?
We are in a pretty similar boat. We don't see a lot of impact at the macro level happening from AI. When we look at hiring on LinkedIn, when folks are updating their profiles, it's pretty consistent with what you would expect with higher interest rates, a higher real interest rate. So we aren't seeing any major impact, even when we look at the share of different job postings, whether they're occupations that are more likely to be exposed to AI or less likely to be exposed to AI. The trends are pretty similar. Even when we look at hiring, the trends for the least exposed occupations and most exposed occupations are pretty similar, which tells you it has to be macro. It's a broad impact effect that's coming from the fact that monetary policy is still restricting the economy.
You guys, this is really interesting, but also it seems as though What people are worried about is the future, right? Even if the AI is not biting now, there is this concern that at some point there will be, and we're seeing youth unemployment, which has ticked up, and a particular sort of malaise or concern around that cohort. Corey, what are we seeing in terms of sort of entry-level positions right now? And is there any way of sort of forecasting what that is going to look like in the future?
Right now, entry-level positions are performing on par with experienced positions. So we aren't seeing a big differential in the pace of hiring, even when we look at specific occupations where we think there's a lot of AI use and exposure, like software engineers. So right now, entry-level is generally on pace with what we're seeing overall for experienced workers. Going forward, what I would expect is we'll actually likely see some recovery when rates come down for entry-level workers, because it is driven very much by economic conditions.
And Martha, what about you? What do you think is going to sort of drive that AI narrative next year? And will we start to see more of an effect?
I mean, I just agree with everything that Corey is saying. I think we are not going to fully see the impact of AI on the labor market, or start to see it, until we get into a next recession, right? That is a time when employers often, make productivity enhancing investments, aka they fire workers. And we'll start to see who may be affected by this a little bit more. I also think we have to keep in mind technological disruption, yes, is incredibly painful. It also takes time. It is not the case that you introduce a new technology and employers immediately know what to do with it or immediately adjust their workforces. I like to say electricity didn't change the labor market. What people figured out what to do with electricity changed the labor market. And so we have to still wait for employers to figure out how they're going to use AI and what is going to make sense for them and their workforce.
I want to ask you about something slightly different here. And this is a discussion we were having earlier on the show with some economists, which is that we're expected to see some tax stimulus flow into the economy next year, both to companies and to individuals. And I guess the question is how the companies will spend that. Will they spend it on hiring, or will they spend it on other things? Just want to get your responses quick to this one. Corey, you first.
If we start to see some increase in demand, right now we haven't seen AI take over a lot of jobs. So we'll likely see a boost in hiring in order to meet that increase in demand, if that's what we do see. But for a lot of folks, they've already anticipated these tax cuts. Some businesses have anticipated them. They've already decided how they're going to spend them. So we may not necessarily see a meaningful surge in demand. And so I wouldn't expect a change to the trend in hiring that we're seeing right now.
And Martha, how about you? 20 seconds.
Our modeling shows a very, very modest boost to the economy next year, but people shouldn't get overly excited about this.
Fair enough. Martha, Corey, thank you so much. Really appreciate it. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance is coming up.